Ladies and gentlemen, good day and welcome to Hindware Home Innovations Limited Q4 FY'24 earnings conference call hosted by Yes Securities. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Udit Gajiwala from Yes Securities. Thank you, and over to you, Mr. Udit.
Yeah, thank you, Manuja. Good afternoon and welcome everyone. On behalf of Yes Securities, we invite you to Q4 and FY'24 earnings conference call of Hindware Home Innovations Limited. From the management side, we have Mr. Sudhanshu Pokhiyal, CEO, Bath Business, Mr. Rajesh Pajnu, CEO of Pipe Business, Mr. Sandeep Sikka, the Group CFO, and Mr. Naveen Malik, CEO and CFO of Hindware Home Innovations Limited. I would like to hand over the call to the management for your opening remarks, post which we open for question and answer session. Thank you and over to you, sir.
Good evening, ladies and gentlemen, and welcome to Hindware Home Innovations Limited Q4 and FY'24 earnings call. I hope you would have had the opportunity to go through our results presentation shared with you earlier. I will initiate the call by taking you through the overall performance of our company. In FY'24, our consolidated revenue was rupees 2,800 crore and EBITDA stood at around rupees 275 crore with margin at 9.8%. During the Q4, the consolidated revenue was rupees 774 crore with EBITDA at rupees 65 crore, with margins at 8.4%. The retail business of the company operates in a highly competitive market, especially with the emergence of many online furniture stores. Consequently, the business sale growth and profitability have remained under pressure. Despite diligent efforts over the past years, the retail business has continued to incur losses. The board has decided to discontinue operations of the retail business and approved the sale/liquidation of various related assets. Based on a preliminary assessment, the company has made provisions amounting to rupees 20.30 crore, including an impairment of its investment held in Evoke Home Private Limited of rupees 9.55 crore. The net impact on the consolidated financial statement amounts to rupees 15.58 crore. The additional impact, if any, of sale/liquidation of assets will be provided as and when finally assets settled. However, the same would not be material in the opinion of the business. We believe that now is the perfect time to leverage our business synergies. Over the last 6 to 12 months, we have conducted internal studies that demonstrate the potential to reduce costs and improve operational efficiency by integrating certain backend functions of our bathware and consumer appliances businesses, and the same is underway. Now I will request Sudhanshu to share an overarching update on consumer appliances and bathware business.
Thank you, Naveen. Good evening and welcome everyone. Let me start with the bathware business. Despite the subdued demand environment which resulted in muted revenue growth, our EBITDA margins expanded from 13.9% in FY'23 to 15.4% in FY'24. This expansion occurred even after increased marketing spends on cricket platforms for brand building such as World Cup and Asia Cup, which were like one-offs in this year. Looking ahead, we further anticipate a further margin expansion of 1 to 2% over the next 18 to 24 months. In FY'24, our revenue stood at 1,580 crores with EBITDA at 244 crores, and in Q4 FY'24, revenue amounted to 421 crores with an EBITDA of 65 crores. Customer response to our newly launched products has been very encouraging, with new products contributing to 18% to FY'24 revenue. Our net working capital days have also shown improvement, decreasing from 112 days in Q4 FY'23 to 105 days in Q4 FY'24. Our strategic initiatives reflect our commitment to innovation and delivering value to customers. With diversified offerings, a strong brand, and ambitious expansion plans, we are confident of our continued growth. Now I'd like to take you through our consumer appliances business. In FY'24, revenue amounted to 422 crores with EBITDA at minus 13 crores. Q4 FY'24 revenue amounted to 108 crores with EBITDA at minus 7 crores. Headwinds, inflation and muted consumer sentiment have affected profitability. We are undertaking various steps to reduce costs and enhance efficiencies, and you'll see the results of the same by Q3 of FY'25. We have seen multiple synergies between the CPD and the CPD business in marketing, in customer service, warehousing, logistics, institutional and retail sales, and we are working on those to bring significant cost savings for the entire company. Thank you. I will now hand over to Rajesh.
So, good evening, everyone. Thank you for joining us. Q-Flow, our plastic pipes and fittings brand, continues to lead as the fastest growing brand in its sector. Our FY'24 revenue amounted to 744 crores with EBITDA at rupees 72 crores and an EBITDA margin of 9.3%. Our Q4 FY'24 revenue amounted to 244 crores with EBITDA at rupees 26 crores and an EBITDA margin of 10.9%. To enhance our market share, we are diversifying our product portfolio to provide comprehensive plumbing solutions. This includes introducing foam core pipes and inspection chambers very soon. Also manufacturing of PTMT faucets and accessories in this year. Again, the double wall corrugated, that is DWC lines are in progress and to be commissioned around August or September. With a commitment to ongoing product innovation and development, we currently offer over 2,000 SKUs with numerous additions in the pipeline. We have a network of 300 plus active distributors and over 30,000 dealers, ensuring widespread accessibility of our products. In line with our strategic objectives, the construction of our new manufacturing plant in Roorkee, Uttarakhand, is on track and will be operational by the end of Q3 FY'24-25. That concludes the opening remarks, and I would like to ask the moderator to open the floor for the questions and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chirag Failoke from Ratnatraya Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. Just two questions, and I'll get back in the queue. First, for the consumer appliances business, could you give us the gross margins for that business for FY'23 and FY'24? I know you already give us everything else, but for just these 2 years, is it possible to highlight the gross margin for this business?
The gross margins are in a range of around 28 to 33%, which has slightly come off by around 2-3% as compared to the last year.
Is it possible to give us the numbers? Is it 33 to 28? Is that what we should take?
Basically, we have not been disclosing gross margins separately for this business, so that's why I'm making it a range form.
I'm trying to just get to what kind of operating deleverage did we see because of sales degrowth, and what kind of actual gross margin compression did we see? Could you tell us just basically what percentage of gross margin compression would have happened in FY'24 maybe? If that's easier to answer.
Sorry, I couldn't hear you properly.
Could you just tell us what percentage of gross margin compression happened? So did gross margin compress 100 basis points, 200, 300? Just a range of that will be actually useful.
So around 3% compression happened, 2 to 3%.
Understood. Perfect. And for FY'24, could you highlight the pre-Ind AS or the adjusted EBITDA margin or just the lease liability for FY'24?
You want to see how much was charged to depreciation and interest?
Yes.
On a console or a standalone basis?
Console.
So I'll get back to you on that. I don't have it readily with me.
Do you have the standalone number?
Sorry?
Is the standalone number available? Is that possible to?
We'll just give, once you're back at the queue, we'll give these numbers to you.
Okay, thank you.
Yeah.
Thank you. The next question is from the line of Arvind Dureja, an individual investor. Please go ahead.
Hi, good afternoon, everyone. So I just had one question, and it is regarding the consumer appliances business. Now, if I look at this segment, this has been dragging the entire profitability on a consolidated basis. So can't we spin off this business into a separate entity? Or what can be done? Because this has been dragging, the return ratios for a long time. That's it from my side.
So, nothing is planned as such to put it in a separate SPV as such. But the good part about this business is we have made good headways into one or two segments, like cooking, cooktops and chimneys is one key core area wherein we have performed. So where we are losing is more on the seasonal businesses. So we are trying to rework the strategy with Sudhanshu leading the strategy now. Sudhanshu would like to add that.
Yeah, so I think your question is very valid. The results have, of course, been dragging the overall consolidated performance of the company. And as a consequence of an action which has to be taken to improve this performance, we've gone ahead and actually started looking at how we can leverage the strength of the bath business, in the consumer business. So in the last 3 months, we have gone ahead and actually consolidated, for example, a customer service function, which is a very significant cost as well as a very important consumer-facing function for both bath and consumer divisions. So that's now consolidated. It's bringing us substantial savings as well, and also improving our customer service in the market. We've consolidated our marketing functions because the brand which is consumer facing is also pretty common. Hindware, we use Hindware smart appliances, and Hindware Italian collection as our leading two brands. So, but the marketing team definitely can work very synergistically. We've also started working around warehousing, logistics. We started working around institutional sales and even sanitary channels, for example. So our sanitary channel, of course, sells many products which are basically a part of the consumer division. So we believe that these synergies will definitely help us in terms of optimizing our costs as well as driving our growth. And early days right now, we are producing extremely positive momentum because of that. As I mentioned in my opening remarks, I think you will see substantial improvement in the next 2 quarters, as a result of some of these actions which we take.
So just to add to what Sudhanshu said, these actions are actually multifold. One is relating to reduction of manpower costs. So historically, our manpower cost as a percentage of sales has been higher. With this mechanism, we have taken certain layers off in terms of support functions, because they were two separate silos but doing the similar kind of service to the market. And from the customer perspective, the customer was, was not having an issue, because both are under the name of brand Hindware. Like 2 separate service centers have been merged into one, call centers have been merged into one. Similarly, the people who are providing service has been done. So you will see savings going forward on the manpower costs. You will see savings coming in on account of the operations, as Sudhanshu said. So this will lead to, we feel that on manpower and all this together, 1 to 2% overall effect on the savings should come in the months to come.
The participant got disconnected. Thank you. The next question is from the line of Pranav from Omkara Capital. Please go ahead.
Hi, sir. Am I audible?
Your voice is not that clear. It's muffled right now.
Is it better now?
Yes, slightly better.
Yeah. So I just actually wanted to know what are we looking forward when it comes to our segments on bathware, consumer and pipes? How do we see FY'24 in terms of revenue and margins? And based on our current debt, what is the movement that we would see going forward as well?
So basically, if you see financial year 23-24 has been a year where most of the consumer companies had faced headwinds. We feel based on our studies and based on the current market environment that demand should come back once the election is over by middle of the Q2 of this financial year. And once the demand comes back, we will like to stick to on the bathware business. We had given a guidance that we should be able to grow, in the multiples of the market growth, ranging around 1.5 times to 1.5 times in terms of the market growth. Let's say the market is growing around 10%, we should be able to benchmark growth between 13 to 15%. I would request Sudhanshu to actually talk more on this, how he sees the market and go more like that.
So Pranav, I think what is happening is that in the real estate cycle we have the product projects which perhaps would have got launched during COVID would have kind of fructified at this point in time. However, there were hardly any launches during that period of time. So that's why we are seeing a little subdued demand. So what we believe in the organization is that over a long-term CAGR, the market is of course growing at anywhere between 8 to 10%, and we maintain our guidance at 1.25 to 1.5 times market. So we continue to maintain that guidance, and of course for a shorter period when you see this thing, it may look that your growth are less. But I think at an overall level, we maintain this guidance. The positive part of the thing is that we have managed to improve our operational efficiencies, and as the growth comes back with the launches which happened post-COVID, we will definitely see profitable, healthy growth in our bathware business. That's what we believe that. And we are already seeing that, for example, in our in the cycle, the pipes business, of course, comes before, and you see strong volume growth in those. So that's an indicator that yes, of course, volumes are of course coming back. Volume is a key indicator of the transactions that are happening. So that's what we believe. I think it's just a question of time. We believe from quarter to end, quarter two, we should start seeing substantial stuff coming back again into market.
Okay. And so on the margin side, what do we see our margins going for FY'25?
So we have given the guidance in my commentary that we believe we can improve our EBITDA margins by 1-2% in the next 18 to 24 months. We maintain same guidance.
Okay. And on the pipe side as well, we would be seeing what kind of volume growth and the margins as well?
Anish, if you can take this, please.
Last couple of years, if you see, you can't guide about the value, but definitely volume, because the raw material prices are at rock bottom. So all the industry is being configured as far as the volume growth is concerned. So we had a volume growth which we have reported of 15%, and we in future also in the next coming year we are assuming that yes, definitely we'll have a volume growth of the same amount, maybe around 15 to 17% guideline. Then the industry itself has given that volume growth. As far as the EBITDA margins are concerned, we have improved a lot in this current financial year, and we are expecting to grow by say around 1% more in the next coming year.
Okay. And so just one last question on the debt movement. Where do we see our debt going forward?
Somehow, actually, we have not been able to maintain our guidance on the debt level. So debt levels have increased. So on a consolidated basis, we have closed the year with a total bank debt around 836 crores. And this is costing us around 8.64%. And it has increased as compared to last year because there is an underlying capex which is going on in terms of the pipe expansion. And also, one of the key things which we are focusing on is enhancing our brand presence on the street. So we have invested somewhere around 20 to 25 crores in terms of
the brand shops which we have opened. These are basically the dealer shops which we do at our expense, but under an arrangement. So these sort of capexes which we have done, and working capital also, we are also trying to save money there. So, but I think give us a quarter or so, I think we should be coming back with a fresh guidance and how the debt level should come down. So I would request if we can get a time of 1 or 2 quarters, that will be good for us.
Okay, sir. Sure. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Udit Gajiwal from Yes Securities. Please go ahead.
Yes, sir. So just a follow-up from the previous participant. First is on the fundraising that you all have taken the board approval for. Could you give some more clarity as to what will be the quantum and the use of those funds for?
So board has in principally authorized HHIL to look at alternatives if we can raise more equity given the fact that the total debt level is high. And we are in process now of appointing consultants or financial intermediaries, lawyers who can help us on this. Based on that assessment, and based on the dipstick on the markets, we'll go back to the board, I think in next 1 or 2 months. After the board announcement only we can make a form confirmation to the market as such. But the plan is broadly, we can do some rights or some preferential and raise some equity capital. I can't talk about the quantum. Can't talk about anything unless it is formed by and approved by the board.
Got it. So primarily it is for repayment of your debt, firstly.
Yeah.
Got it. And so what will be the ongoing capex now for, say, FY'25? What is the budgeted capex?
So we have an ongoing capex on the pipes, and where we are setting up a plant in Roorkee, wherein we still have to invest somewhere around 80-90 crores. Plus, apart from this, we continue to invest into the development of our distribution, and that means development of shops across. So we feel a capex of somewhere around 120, 130, 40 crores. That's the range bound what we are looking at.
Understood. And sir, X of any fundraise, I mean, is there any principle that you would, the plans to repay the debt if the fundraise is not happening from internal accruals? Do you plan to repay any debt on an annual basis, or it all depends on fundraise right now?
As we don't have any subsidiary, all the EBITDAs we generate, if we're not spending on a long-term capex on everything, it ultimately goes for the debt. But give us a quarter or so, I think we should be able to get back with a more firm plan. That and we can confirm only once the board has approved.
Got it, sir. And so lastly, on the pipe side, so the plant is starting in Q3 of next fiscal. So by then, do you see any challenges because the quarter, I guess, utilization was in north of 90%. That's kind of unusual in the plastic pipe business. So do you see any capacity constraints in the near term?
Rajesh?
Will be around end of the quarter. So we'll get 1 full quarter to utilize the capacities which we are installing at the initial stage. Hello?
Yes, sir.
Yes, sir.
Yeah, am I audible? Okay. So we'll be utilizing those capacities for the full quarter, which we'll be installing during our commissioning. In future also, we have the option to increase our capacity here because we are making the complete plant, but we are not installing all the machines. We are seeing a good guidance growth as far as volumes is concerned. The only challenge is the value. Once the raw material goes up, then value growth will also be there, but volumes are always there in this industry.
Understood. And sir, on CPVC pricing front, could you highlight that have the prices bottom up, or what's your view on the same for this fiscal?
CPVC prices are stagnant for the last 2 years. They are neither going up nor going down. It's only a little of competition that has happened. But we are expecting that Q2 of this financial year, there will be a pickup, as Sudhanshu rightly said. all these people are just waiting. June, all these projects which are going to start, which are there on the table, which have got launched. The projects have got launched nationwide. They need CPVC, and we are offering almost all the projects of the country now. But it is the kickstart of the project. Once that happens, pipes will be the first thing after the structure will go there. So we are seeing by the end of Q2, there will be a shift for CPVC demand in the country.
Noted, sir. Thank you for answering. Thank you.
Thank you.
Thank you. The next question is from the line of Nikhil Gada from Abacus AMC. Please go ahead.
Hi. Thanks for the opportunity.
Nikhil, sir, can you be quite loud?
Yeah. Is it audible now?
Yes, please. Go ahead, Nikhil.
Yeah. Hi, sir. First of all, congratulations on a decent set of numbers in a weak environment, and also regarding the retail business, so that is now behind. So just firstly on the bathware business, if you can highlight, just need some numbers. How is the mix looking like in FY'24 versus FY'23, and how much the dependency on China has reduced?
What was the first question? I couldn't get it.
So the mix in sanitaryware and faucets in terms of premium versus economy, and vis-a-vis FY'23.
Okay. I think Sudhanshu, why don't you first talk about China?
Yeah. So, hi Nikhil, and let me just try to get the numbers for the first question. So for the China thing, lots of good news here. In fact, what we have been able to achieve is, from a nearly 20% contribution about a year ago, we were reduced to 7-8% in this year, and in FY'25 we are basically plan of 3%, which is actually a far lower number in terms of China imports. Our dependence on China has actually come down substantially, and in addition to that, we have also been able to in-source a lot of our production within our plant. So we'll also not just see production from China, we'll also see a lot of in-sourcing into our own plants, in both sanitary and faucet plants. So we've been able to achieve this objective in the last few months, and the impact of that you'll see in FY'25. So that both these numbers are now very, very positive. As far as overall number is concerned, in terms of premium and entry level. So for us, 46% of our business is basically at the economy level, and the premium level is basically about the balance 54 odd percent. That's our number for sanitaryware. And in faucetware, the way we see our numbers, about 45% of our business is at the premium level, while 55% is basically at the economy level. So on a combination basis, if I see our economy level products are basically at about 49%, and about nearly 51 odd percent is at premium, the way we define our business.
Would it be possible to give the same number for FY'23 as well? How much that has changed?
Yeah. So I'll just give that to you. Just give me a minute.
And also, if it's possible, the in-source production number, if you can give how much we are doing in-sourcing versus outsourced in FY'24, and how much that number was in FY'23.
Yeah, so for us, the change, there is a bit of a change in terms of contribution in our entry level or economy level versus premium level. We basically in FY'23 we were at about 45% on economy level, which is 49 in this year. So of course there is a reduction in our entry level, in our premium level in terms of percentage contribution from 51 to 55 to 51% on the premium side. Okay. As far as manufacture is concerned, we are in FY'24. Just a second.
Yeah.
In FY'23, we were at 63% manufactured. In FY'24, we were 60% manufactured. So 3% reduction.
Because we are making the changes.
Yeah, because we had announced in the previous investor call that we were making these changes within our manufacturing setup, and we had increased our outsourcing, but all those changes have happened now. We expect this to decrease to nearly 75-80% in sourcing in sanitary ware in FY'25. In faucets, our in-source, just a second. Yeah, this is it. Okay. The manufactured is, our own manufacturer is only 34%, while 67% is outsourced in FY'24. And in FY'25, this is expected to be about, anywhere between 75 to 80% in-sourced and 20% outsourced. So it's going to be a substantial increase from 33, 34 to nearly 75, 80%.
Okay. So, sir, just on these numbers, two things. So, firstly, if we are going to see such an increase in in-house manufacturing, and I'm sure that the premium number which has gone down will also be sort of lifted up because of the way we are going to do in-house manufacturing. Don't you think this margin expansion number that you're talking about, 100 bits, is it not a bit on the lower side, or do you think that we are going to do more ad spends, so from that perspective we are just guiding for this kind of margin expansion?
No, I think we've been maintaining, this guidance from the previous year as well. And I mean, you can call us conservative. I agree with you. But yes, I would stick to the same guidance at this point in time.
So allow us to perform first and then we'll get back. We wait for a few quarters.
Got it. And just last question on the sanitary ware and faucets. While we have seen a substantial decline, in China procurement, the same is not visible in the working capital cycle. Do we think that this will be more sort of will see a significant reduction in FY'25?
Yeah. So on the working capital side, there is a bit of a impact around the receivables because of the slowness of the market. The way that project is structured in terms of some payments being generally delayed in the market, the ongoing elections which are happening in the market. I think it's a short-term phenomena. I think I'm not too bothered by that at this point in time in terms of as a structural shift which is happening in our working capital. Our inventories have come down, and they will continue to come down. If my China thing had actually substantially been erased, then it would have actually shown in my inventory in this year itself. What our China contribution in our sales has come down, but our inventory is still lying. That basically is the result because of which we see some bit of higher working capital, and additionally because of the receivables. I think on both those aspects, we will see, because we are at about 7-8% even now in terms of our China contribution. So that inventory is actually coming down for us, and in my view, when I come down to 2 to 3% in terms of total contribution of Chinese imports in my business, then the full reflection of that will come in my inventory.
Sir, any number you can guide on this, or is it as of now too difficult to sort of capture this?
On the working capital?
Yes.
I think we have
look at 80 days or 90 days of working capital, yeah.
Based on 31st March 24, we have internal targets ranging around 10 to 15% reduction over next 12 months.
Okay, got it, sir. So then on the pipes business, would it be possible to give a mix for FY'24 versus FY'23 across CPVC, PVC?
Rajesh, if you can take this, please.
Nikhil is there. Please come again.
Sir, mix between CPVC, PVC, HWR column pipes for FY'24 versus FY'23.
The mix is like, since there is a volume growth, so it has all happened in non-CPVC. We can't guide for product price. benchmarked as PVC and non-PVC, that is CPVC. So the growth in terms of percentage was there in non-CPVC. Because CPVC is stagnant, as I earlier said, for the last 1.5 years. And it has been PVC which has been driven by the demand of JJM, Jal Jeevan Mission, Har Ghar Jal and all other projects. The PVC demand has gone up and the percentage of PVC has gone up than the percentage of CPVC.
Got it. Would it be fair to say that CPVC growth was flat volume?
Yes, CPVC growth is flat throughout the industry. We are presuming, as I said earlier, that last Q2 onwards, we believe that all projects should take up and CPVC would pick up again, because last 20 years, this is the first year that CPVC has not grown for the industry.
And sir, in that same context, is it possible to give mix between housing? I know agri we just entered, but housing, agri, infra, what kind of mix we have currently?
As I said, we are giving the guidelines because we have been that our quantum of our CPVC has to be around 45%. And we had touched that the year before this, but this year it is only 40%. So the next year, the target would be that out of our all product mix, CPVC has to be there at 45%. So the housing demand should come up, say, last half of this year.
No, so I understand that we might also be selling PVC for housing as well, right? So from that perspective, how much?
PVC is proportionately, PVC in the housing segment is proportional to the demand of CPVC basically. There is a plumbing and sanitation which goes hand in hand. So whatever we have been able to do last quarter, if you see our results, the results are very good because we changed our focus from housing to a little bit of agri because we were not there. Still, we are not doing SDP, MDP, DWC because we are not into that segment. But we have done well. We believe that it should, to have a better bottom line, the quantum of CPVC or plumbing has to go up.
Sir, so I'll just ask it in a different way. What kind of a mix you're targeting in FY'25 between housing, agri, infra? Because you're going to get into DWC as well as...
See, actually, if you see, Nikhil, 90% of our sales goes to housing only. Correct. As of today. Correct. So, and 10% is to, this year 10% is to the other market, which we say agri market, or even we can say that it is like layouts and all other markets. Correct. So we are presuming, since we are installing more capacities by the year end in Roorkee also, so this mix may grow also, but parallelly CPVC has to grow. So it all depends if your production volumes go up. That is, your capacity goes up, you can have a mix of 80-20. That will give you a good, better bottom line and a top line.
Got it, sir. And sir, just from the perspective of, once the Roorkee plant starts from third quarter onwards, what kind of savings do we see in this entire logistics and, from an operational perspective as well?
See, Nikhil, more of a saving, if you know this industry was because freight is a it's very freight sensitive, the product pipes. So we have to be there very near to the market manufacturing pipes. It is not that we are, one, we'll be saving on freight. Second is that you need to be, because in this, you don't get a lead time in this type of business. So transporting the pipes from here to north and then to our depot and then somewhere else, we need to have manufacturing bases around the country. That is why if you see our competitors are operating with multiple plant locations. So this will be our second plant. And we will not stop here. We have to grow. So that is a big saving that you will be trying to increase your top line. This is not possible from a single plant.
Yeah. So my question was from a perspective that the moment our plant starts, do we expect in next couple of quarters to reach this, 70, 80, 90% sort of a utilization based on the demand that we have and our overall share that we have in?
Yeah, of course. That is the reason we are putting it, because already this plant, we are in the industry, we are having the maximum capacity utilization from this Hyderabad plant. So we are operating at around average of 78%, which nobody does. So that is why there is a demand, but supplying PVC pipe from here to that portion will never be feasible. It's only CPVC. So we will be operating and there by manufacturing all these pipes. With pipes, what will happen is fittings, this will remain as a mother plant. You transport the fittings doesn't have a freight cost, and you sell more.
Got it, sir. Sir, just one last question, if I can. You mentioned that in the consumer business, you mentioned there will be a 1 to 2% benefit because of all the actions that you are planning to take. This you are saying in terms of margins, right? That will straight away see that reflect our margins.
Yes.
And so in consumer business, since we were rationalizing and have been rationalizing, we have seen a degrowth as well, in our business. Definitely there has also been a weak demand as well. Do we see this business going down further because of some more rationalization, or from here do we see growth coming back in this sort of segment?
So, I would be able to answer this question far more clearly in the next investor meet, but yes, we see growth coming back strongly in this.
Okay, fair enough. And so lastly, any part is remaining for the retail business that we have to take in the numbers and provisions?
So, based on the assessment of all the assets we have already provided, and we are in process of selling inventories. Now since the business is closed, although we have done a study, what we should be able to realize. If there is anything, upon the final realizability, that will come to the picture. But predominantly, I think almost 90% plus idle basis we have provided. Maybe, there can be some saving little bit or some charge depending, how we are able to do that.
Thank you. The next question is from the line of Tushar Raghate from Kamakya Wealth Management. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. So I could see that inventory days has reduced from 283 to 141. So what are the targets for FY'24 in order to reduce our inventory days?
Your voice is not clear to us. You have to repeat.
Okay. Sir, your inventory days has reduced from 283 days to 141. What are our internal targets to reduce it further for FY'25?
Inventory days?
Yeah.
Which business? You're talking consolidated business?
Consolidated, yes.
Okay. So, we have given a target that whatever we are there on 31st March 2024, our internal benchmark target is to further optimize, ranging around 15% over next 1 year on this.
Got it, sir. And so this consumer business, any plan for this to divest, or because the business is not adding up in terms of margin, because the manufacturing asset margin increase getting camouflaged by the appliances businesses. Wanted to understand your view for the consumer business.
We can't get your question clearly, to be very frank.
So basically, I wanted to understand, when can we expect the revival in the consumer business? Because there is no addition in terms of margins, or even the growth has been flat over the years. So what is your view on that?
So I think this is Ranshu, and as we shared, we have done a lot of work around cost optimization so that this business becomes profitable. We discussed that, we shared how we are trying to build in synergies between our consumer business along with our bath business. So like we said, there will be a lot of optimization which has happened on the manpower cost, operational costs like warehousing, logistics, and of course on marketing side. So these three optimizations we believe is going to really add into our profitability of consumer business. As far as revenue is concerned, we've seen a decline, but of course, like everybody has seen, the economy overall has been, we're in a slow growth situation at this point in time. We believe that we would be going, we will be coming back into growth in consumer business in the coming quarters. I won't be able to give you a very clear indicative number around that right now, but we'll of course come back with a commentary on consumer business in the next quarter. So your concerns are valid, but I think we have shared plans for the consumer business both on the revenue side as well as on the profitability side, which we believe will show a turnaround in the consumer business in the next 1 to 2 quarters itself.
Okay. Sir, any plans in order to value unlock the building product business, divesting the consumer business into other company as such?
Nothing as such, nothing is proposed, nothing approved by the board in this regard.
Fair enough, sir. Thank you.
Thank you. The next follow-up question is from the line of Chirag Feloke from Ratnatraya Capital. Please go ahead.
Hi. Thank you for the opportunity again. Just a clarification on the discussion that has been going on the consumer appliances business. So just to be clear, your guidance is right now in FY'25, we'll probably still see an EBITDA loss, right? Because we are at a 3% loss, which will probably 100 basis point improvement will still get us to a 200 basis point loss or a marginal loss. Is that the right way to think about it?
It's difficult for us to make any guidance for the current financial year, and that's not our practice and policies. But we feel that we are trying to grow this business. We are trying to optimize the costs which are relating to this business. You will see the growth happening in this business, and as the growth happens with the healthy margins, I think in the next 3-4 years, we should be touching somewhere around 8 to 10%. But it's very difficult for us to advise you or guide you or give any guidance on FY'25 numbers.
Understood. Fair enough. And from a top management perspective, could you just help us understand on the internal team and forgive me if this question is not coming out correct, but there's been a decent amount of attrition, change, however you want to put it, on the top management also. Would love a couple of comments on that, on what is evolving in the team and what has transpired in the last 12 to 18 months.
So basically not much changes, but optically you will see that happening more on the consumer product side. So you have to go into the history of this. If you see, we incubated this business around 8-9 years back. And the philosophy which we worked on it was that we incubate silos, creating verticals, and that vertical should be totally focusing on the growth. But as a result of this, there is an increased manpower cost which has a lot of impact on the overall margins and the investor perception. We have been analyzing over the last 12 months at how we optimize our manpower costs. So one of the very good idea which came was that there are certain functions like brand Hindware marketing, it's better that bathware and consumer products go together. Because from the consumer perspective, it is one. Consumer doesn't make a distinction between the two companies or two separate divisions. So we have consolidated that. We have consolidated the after-sales service. We have consolidated the call center. We have consolidated. When I say consolidated, means the process has started. The full impact will come through in a manner. Warehousing, we have even some part of the procurement has been consolidated. When we do the shops here in the market, even that consolidation happens. Most of these decisions have been taken somewhere in the month of February, March. The impact of this you would see going forward. So this is one key element. And apart from this, Sudhanshu has already spoken about that once these both businesses are together, there are a lot of synergies of a cross-sell. When a customer is trying to come to a counter, let's say on the bathware side, we have, let's say, X number of counters, and the customer is coming, those dealerships can make a soft approach to the customer in terms of offering chimneys and other products, which otherwise customer keeps looking in the market and then get the conversion done. Similarly, vice versa. So a lot of synergies we are seeing there, and given the fact that there is a base factor now on the both kitchen chimneys, hobs, and also on the bathware business which has been growing. So the whole effort of the management changes which we are seeing are relating to that. So Sudhanshu is now spearheading the entire process, providing strategic inputs at how the CPD integration happens into the overall, the stronger points we have on the bath business, and how we can totally upscale the business considering both the businesses together. The respective turnovers, the respective products, definitely. When I'm saying this, it doesn't mean that we'll start selling kitchen chimneys in Hindware. But respective companies will have their own, respective P&Ls as it is moving in the current, as it is being shown right now. But there is a synergy, and that synergy is being, unveiled now.
Understood. Fair enough. Thank you so much for the opportunity.
Thank you. As there are no further questions, I will now like to hand the conference over to the management for closing comment. Over to you, sir.
Thank you very much. On behalf of Hindware Home Innovation Limited, I'd like to thank all of you who joined the call today. I hope we have been able to answer most of your questions which have been asked. If any still left out, we'll be very happy to answer. Thank you very much.
Thank you. On behalf of Yes Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.